guys, Mike here. So, oh boy, what a day. And let me tell you, it looks like the market did not like what the Fed had to say in their FOMC minutes, which were released at 2 p.m. as I told you they would be. And initially we got the pump, but then of course we got the dump. And I'm going to go into what they said. Shouldn't shock anybody, but I will tell you. I'll also tell you what I think the Fed's plan really is and what they're going after. And I've told you this one before. I'll also show you some things that kind of backs up what they're saying, what their estimates are and stuff, and why that is. And then some really critical things you need to know, especially that happen on one of the weekly charts, happened to Tesla, and some other stocks and stuff. So you do not want to miss that. Now, here's what I think is happening. One, they said obviously they believe in they keep raising rates. Someone want to do a pause in September, maybe raise in October, but rate hikes are still on the table. So, of course, people said, they're still hawkish. Well, yes, I mean, they've basically been telling you this, right? Now, maybe the market will believe them at some point in time. They also said they don't see a real slowdown or impact until 2024. And I think the name of the game for them is what they're really going after, and I've said this before, let me know what you think in the comments, is one is wages, right? And when you look at what I'm talking about here, this is the wage growth tracker, and you can just see when we do little arrows here that they have successfully got the wage growth slowed, right? It's going from like 6.5, almost 7, to around 5.75. But when you look how high this is. I mean, this goes back to the mid 90s, and you can look right there. We haven't ever really been that high since the mid 90s. I don't know what happened before that, but here's basically your average, anywhere from like 3 to 4, somewhere in there, as far as growth, okay, if you just kind of look. And so I think that's what their target is. I think, companies are reaching out to them, and they even realize, hey, man, wages growing this fast, we can't have it. And so they're trying to get so much, not wages down, even though how you do that is to make people unemployed, but to get wage growth down. And how you do that is you slow the economy. So again, what did I tell you about small companies the other day? 44% of them still report that they can't fill jobs, okay? Still have jobs unfilled that they really want to put out there. That's not these big publicly traded companies either, okay? And so keep that in mind. And so what do? You decrease those number of jobs out there to where competition isn't as fierce and they don't have to offer as high a wage, okay? And so I think that's one of the main goals right here, even though they won't come out and directly say that. Now, the other thing is, why are they projecting out to 2024? Not that they've been accurate at all anyway. As far as the slowdown and stuff, is because one, it's about 15 months normal on average before you start to feel the rate hikes, and now we're right at around 15 months, if I'm not mistaken, 16 months. And so you're going to start seeing them, especially in the banking sector, which you've already seen, but that's going to happen more and more. But the other thing is, reason why I think they project that, because now they're realizing how much they underestimated stuff, right? What is one thing they underestimated? Company debt, right? I mean, if you look at this, nearly half of the S&P 500 debt is set to mature around 2030 and after, okay? And so you look at the years before that, yes, this hasn't matured, they're gonna have to refinance or whatever they're gonna have to do, but the majority of it, at least half, doesn't come till 2030. By then, rates will definitely be down. There's no ifs, ands, or buts about that, okay? So that's one thing. The other thing is when it comes to us, the consumer, again, what do you see? Mortgage rates continue to rise, and they're at rates now we hadn't seen since 2000. And of course, when you look down at the bottom here, look at the mortgage applications. They're in the gutter, right? We haven't seen this since 2010 when people just couldn't qualify and were scared to death to buy a home anyway. But what does this do? What it does is, like I said, you're sitting there with people like us sitting in our homes, sitting on a boatload of equity. So if something did happen, we have recourse. We can go take HELOCs out. We can refi if we had to. God forbid, I hope that does not happen. But that is something else. Number two, if people can't buy homes or are unable to buy homes, what else is happening? All that money they saved up, they're not putting it down on a down payment. So it's just sitting there. It's either going in the stock market or sitting in some money market account drawing money. And so they're not having to put these huge payments down and stuff, okay? So just keep that in mind. What else is going on? If people aren't buying homes, they're not buying appliances. They're not buying furniture, all this stuff, right? So all those major purchases, as Home Depot said themselves and they reported, they see these big purchases are decreasing quite a bit, right? And so all that money is still just sitting there, right? Drawing 4 to 5% interest somewhere in there, which I think is like $20 billion a month on these $5.5 trillion money market accounts. And then obviously that, if it ain't going there, it's going into the stock market, right? Or the bond market, one of the two. And so just keep that in mind. I think that's why they're seeing that. And because, again, we haven't seen these three shortages for a long time at the same time, right? Or ever, I don't think, right? We got people, there are not enough people to fill the jobs, or they don't want the jobs. The companies can't fill these jobs. Two, you got oil companies cutting back supply, right? Even though demand has been dropping, oil prices are going up, right? Because they're cutting back on supply. They won't produce a bunch more, right? Because they want to keep the prices going up and keep them high. Three, the housing go up, right? The inventory is not there, right? And so that's why you see home builders doing so well, because they're going to keep building homes because they have to. And eventually rates will come down. But you see some people are buying homes, right? Because they're being told, buy it now, and then when the rates drop, you can refi then. I know people have done that. And so, those things, we've just never seen this before. That's why the models are broken. Powell has said this. I saw some other guy doing an interview today, supposed to be an expert, said, nope, models are broken. We don't know where this is going, right? They can't really predict where yields are going, where the market's going. And so, that's just the kind of time we're in. So just keep that in mind. And guys, before we continue, if you get anything out of this, please hit that thumbs up down there. I really appreciate it. And if you like the material here and the videos, think about subscribing. Now, when it comes to China, more news out of China, right? And you can see right here, they are injecting liquidity, okay? So in the last few days, they have seen the largest Bank of China injection since February. And you can see down there, you see right there, those little things popping up. That is liquidity being injected. And it's on an equivalent around 41 billion US dollars is what they put in here, because they're trying to do something to inject life in their market. And what else are they doing? Pulling out all the stops, right? Chinese authorities came out today and said they are considering cutting the stamp duty, which is nothing but a tax, on stock trades for the first time since 2008. And so again, we'll get into some of those stocks from China in a few minutes, but they're pulling out all the stops. They're trying any little thing they can to get people to start, going back into their market, reviving the economy, believing in what they're going to do. I even saw they come out and say today, and we're like saying, almost like we're going to guarantee we're going to hit our numbers economically. I don't know how you do that unless you fudge them. So how do you say something like that? How are you going to guarantee it? But again, I've never lived in a communist regime, so maybe they have magic powers. I don't know. But again, you might want to root them on, because if the second largest economy goes down in flames, all these companies, all your 401ks, your IRAs, they're invested in Apple and Microsoft, all these companies like Tesla, who do a lot of business in those countries, or in that country, excuse me, are going to be hurt by it. So you don't really want to see that. So and of course, I don't want to root for their people to be jobless. I mean, they're normal people like us, right? Trying to raise families and just making life. So hopefully that does not happen. Hopefully they'll get their act together and stuff. And it's their government's fault. It's not the people's fault, of course. Now, I get this question a lot, so I'm just going to cover it real quick. They go, I'll have people email me and they say, you seem kind of calm about this pullback or whatever it is and all this other stuff. And I was like, and I keep saying it shouldn't surprise you. And the reason why, for those who don't know this, look, I've been doing this morning news brief for 3 years. I came up with it 3 years ago. I've been adding to it, redesigning and everything. And the whole point was so you could read something in a 5 to 10 minute time frame here, get it done for your morning, get your day started, and understand what the biggest news articles that were coming out. If you want to read the whole article, go read it. I just take the most important parts of the articles, because most of them are filled full of nothing, right? Because they do a certain number of words. And so I put this stuff out like this one, like all the regional banks this morning, they're raising billions of dollars right now over the last 30 and 45 days. That might be something you want to know, right? Tesla cutting prices again, all that good stuff. But the big one is this right here. This is why I'm not surprised with the pullback, and why I was calling for it is because simply, you look at where I got important indicators. You got the fear and greed, both I cover. One, fear and greed does how many stocks are in an uptrend or a downtrend, right? The other one is the CNN Fear and Greed Index. Everybody knows, right? And you see where they're at now. Look at those numbers, 55 and 55. And then you get to see how many stocks are above their 200 moving average. You get to see the VIX. And more importantly, what's going on with liquidity, financial conditions, and then the bank's financial conditions, right? So we just had an NFCI financial conditions update this morning, which I sent out to everybody. And then, of course, you shoot down. You go, here's what the options market is expecting. Here's what max pain is going to be and what options levels to watch and all that good stuff. But when I scroll back, this is August 1st, right here. This is weeks led up to this. Why was I saying we're going to get a pullback? We need a pullback. We're overstretched, because look at the numbers now. August 1st, right, 16 days ago, whatever it was, you're setting an extreme greed on both fear and greed indexes at 80. Anytime you get over 70, between 7 and 80, you can pretty much bet money you're going to get a pullback, right? Look at where all the percentage of stocks were above the 200-day moving average, right? That's kind of a way you can measure breadth as well. And so looking at that, looking where the VIX is at, looking where liquidity is at, all that good stuff, this is what gives you that. So if you follow, and then every Friday I put like how much this has increased during the week, how much it hasn't, and at the end of the month, I'll put during the month, so you see the trend. You can see it. And so you're able to look at that in 5 to 10 minutes max. And if you want to dig in deeper into some of the news and stuff, you can look it up yourself and read the whole article. But again, I'm giving you this snapshot so you can read it really quickly. And if you keep looking at it every day, you obviously, like me, I put it together, you get to see the trend of what's happening. Okay. And so it's not a shock. It's not a surprise. It shouldn't be a surprise. Again, if you want to try it out, links down the bottom, less than a McDonald's combo, $7.99, all right? 7-day free trial. Give it a shot, and we do more than that, obviously. But I just want to put that out there. That's why I'm not surprised. I'm not shocked, because I keep up to date on this stuff, and I listen to what I'm putting out. And so, I'm not going heavy into a market where I sit there and go, oh, man, we're really due for a pullback here. And this is why. I don't just say it. I back it up with charts or this kind of stuff, and it tends to work, So just FYI on that one. Now, if you have any questions, ask me in the comments or shoot me an email. Now, when it comes to indexes real quick, you can see the SPY's below its 50-day moving average, setting on an important trend line. We'll see if we get this bounce. QQQ below its 50, setting on a trend line as well. Could be a coincidence. Also, the QQQ, just to make sure you understand, on the weekly, got its first bearish MACD cross right here this year. And so keep that in mind. We'll see how that plays out and stuff. That does not mean things are going straight down and all that stuff, but just it's not a bullish thing, right? And so, the weekly is a big time frame, okay? So it's more for the long term there. Now, IWM, hot mess. Here it is, sitting at that 186, 187 we talked about, below its 50 as well, okay? So you got all those major indexes below the 50. The Dow's the only one it's not, but this one's sitting on a key level. If this breaks, yeah, we're heading down to hit the 100 moving average and all that good stuff. So just keep that in mind when it comes to small caps. Again, a lot of these in the RSI, when you pull up, are setting in oversold territory. That does not mean they're going to bounce immediately, but usually that's when you start to get some kind of relief rallies. Now, Tesla, we got a few things to look at on Tesla. One, if you look out, obviously, at the long picture here from 2023, and what do you see? Higher highs, and if this bounces from here, right, it'll be still higher lows, because that is bullish from a longer term perspective. This is what I mean. You can be bullish and bearish on different time frames, right? This is the daily. If we move in a little bit and we say, okay, what else we got going on? Well, if I pull up this Fibonacci, you can see, starting from when it started to run up again in April, I believe that was, we're at the 0.50 Fibonacci level, okay? That's usually where you'll get a bounce and stuff. And then what I mean by that, if we scroll back even farther, when it started rallying off that 100, you can see right here on this big rally, if we pull back, you see where it crashed and burned right there. Well, if we pull down here, you'll see, what was it around? Right around that 50% retracement, okay? So that's usually pretty big, the 50 and the golden pocket, which is the 6.5 to 6.18, okay? So just keep that in mind. And it's like I've been telling you, if we lose that 235 level, this thing can drop fast, and that's exactly what happened today. It ended up dropping even more, coming down. Look at this gap right here. Hopefully, maybe we get that one filled, take another one off the board. Again, until it breaks that trend line right there, I don't think people have anything to be worried about at all. And if you're looking dollar cost average in, there you go. If you're looking to sell puts, another thing a lot of people are doing right now because they have a lot of premium, you can do that as well. Just depends on what you believe is going to happen. But understand we are getting close to being oversold here on the RSI. When this happens, you usually see a 5 to 10, maybe even 15% bump, as you can see as I'm highlighting all of these when it happens. Okay, so we'll see how it goes. But the problem is, what happened to Tesla again? They cut prices again in China, right? 2 days in a row now. They keep cutting prices because this price war, and what that does is people are worried about the margins, because we are getting very close to the margins of a Ford and General Motors and Toyota, and so people are really worried about that. And so as they keep cutting, this is going to happen. And again, another thing that worries people is the fact that China just is having a lot of problems right now, with a lot of data coming out of there. And so going on here to Meta, for example, here's another stock hitting the 50. Maybe we'll get a bounce, maybe we're not, but it's the first test in 2023. Like I said, these moving averages, remember, are rubber bands. They always come back to the moving averages. Eventually it will happen. Okay, so we'll see if this one bounces them here or not. It is at a decent level. And then when you go to Netflix, its loss is 50, but it's also sitting right here on this trend line, which is bounced off of multiple times. So we get to see if it finally gets a bounce, or we get down and finally fill another gap, as we're taking notes on every gap that gets filled in all these stocks. And remember, I always tell you, when you see a graveyard of gaps left behind, there's a reason why they always say most gaps get filled, okay? And so when you look at this one, it's another one that could get absolute bounce. You see on the hourly, it's oversold and stuff. And so, again, this is another one setting up for that. And then you got AMD, which looks like a hot mess right now, because it's breaking out of this wedge right here. Obviously, it lost its 50 a long time ago, lost the long-term trend line. It's sitting on 100. It's bounced twice now off the 100 moving average. And so it's trying to regain that 109, 110 area. But another way to look at this, there's going to be a big move soon, because you see this wedge right here. It's wedging down and consolidating really tight. I can't tell you which direction it's going to go. Let me know in the comments what you think. I think, to me, this is going to be based off NVIDIA's earnings, right? If NVIDIA comes out, kills it, does what they did in last earnings, and the market loves it and pumps NVIDIA, I think it's going to uplift all semiconductor stocks, just like it did last time. That's why AMD ran so hard. So let me know what you think. Now, BABA, again, I showed you the Chinese information. This one continues to be hampered by it. Still haven't broke this trend line right here, which really is really what you're watching out for. If it breaks that, yeah, you're gonna see a lot more hurt taking place, in my humble opinion, on that one. But when we look out here, you got plenty of support coming in right here, and so if you're gonna get a bounce, that's where you're gonna get it at. It depends on how the market perceives the China news. If any more bad news is gonna be coming out, or they're gonna get more bullish news coming out about liquidity, because liquidity is king, right? If they can pump it up and keep injecting liquidity, the markets tend to like that more than anything else. But as you can see, it's not just BABA. It's all Chinese stocks. These stocks have been absolutely hammered, okay? And they will continue to be hammered, most likely until the market says, all right, we've had enough of that. They're pumping liquidity. We love you to death. That's what happened in America here. They started pumping liquidity, even though everything looked horrible. And you see what happened to our market. So, again, it is an important market. Now, as far as earnings, you got Walmart, Dole. You got a lot more retailers and stuff. And then, of course, you got Applied Materials, Bill.com, Ross. So again, this is all going to be about the consumer and stuff. Just pay close attention to that. And then tomorrow, a lot of data. We're going to have a lot of jobs data piling out. The Philadelphia Fed manufacturing stuff is going to be piling out. And people tend to pay attention to this because they're big in manufacturing in Philly versus like a New York. And so we'll have to see how jobs data comes out tomorrow. Obviously, the market tends to move on that news, and so we have to keep that in mind. I think they're being much more perceived now, or really paying more close attention to that news now, right? Since these hikes are finally starting to take effect and everything, and you're starting to see it not just here, but on a global scale. Remember, this is a global economy, so just keep that in mind, stuff. And again, we'll see. I mean, if we break those trend lines on the SPY and the Qs and Meta and Netflix, all these ones, then obviously there's a lot more downside. If we get a bounce, don't be surprised. So just keep that in mind and stuff. And again, look at your different time frames. Pull on the daily, go to the hourly, go to the 15-minute, go to the 5-minute if you like, and see where we're at and stuff. So anyway, let me know what you guys think and everything. Green or red tomorrow? Do we finally get some kind of bounce and stuff? Or do we keep on going down? So please hit that like and subscribe button, guys. I really appreciate it for all you guys who have been watching the videos. I always enjoy reading your comments and stuff. So I'll end up seeing you tomorrow.